Hey guys, Kunal here of Bulls on Wall Street. Today I want to talk to you about a topic that is near and dear to my heart. Ways that you can blow up your account fast. You guys have probably heard all the stories of all these famous traders, not famous traders, people in chat rooms, right? And everybody's got this story of how they blew up an account. Whether it's a couple $1,000 or a couple $1,000,000, right? Everybody goes through some form of this kind of drawdown. So why does this happen? So in today's video, I'm going to talk to you about kind of the three major things that I'm seeing recently and currently that would cause traders to blow up quickly. So first one, over leveraging. This one is actually going to be the #1 killer. Let me tell you the reason why. Most traders, when they're brand new, are undercapitalized. So maybe you're day trading, you've got 20 grand, 30 grand, something along that end. And the broker gives you margin. So you're gonna have 4-to-1 margin on your 25,000 or your 30,000. But let's just go with 25,000. So you got $25,000, you've got $100,000 in buying power. So what do you do when you're brand new? You've got itchy trigger fingers, a complete lack of skill, probably a lack of experience also, and you're gung-ho excited because the market is hot and you're seeing other people out there, right, with social media making money. So most people, right, if they have in their account, it shows the ability to purchase a certain amount of stock, they're gonna use up the whole thing, right? A majority of traders, especially brand new ones, if they have a $25,000 account, they're not really gonna just trade with the 25,000 because they're gonna look at a stock like AMD and be like, well, I can only buy 100 shares if I don't use the margin. So they end up over leveraging themselves right off the bat. So when you're taking $100,000 worth of positions on a $25,000 account and you lose 1% here, 1% there, not even like crazy risking, right? You're just taking 1% losses, maybe 2% losses. 2% on 100 grand is $2,000. That's 10% of your $25,000 account. So you can have a bunch of NVIDIA or AMD or just something you think is really safe, but because you're on the 4x leverage, then when you lose, right, you're losing really 4 times more than you would if you were just at 1x. And so that's how you really can blow up your account fast. I've seen this done so many times. Now I'm giving you examples of like some safe stocks that really only move around a couple percent a day anyways. But I can't even count how many times I've seen traders with 25, 30,000 accounts go full board max with riskier names, maybe something that's moving around 10%, 15%, 20%, stocks that are in play that have news out, that can induce some FOMO. Well, now you're getting into that weird blow up situation because if you've got $100,000 of a stock and it's moving around 10, 15% at a time, that's the recipe to lose your whole account. The second part, and I think this becomes really important, when you have smaller accounts and you don't have access to margin, what do traders typically do recently? This is a new thing. They start trading options. Hey, I only got 15 grand, 20 grand, I'm under the PDT. So because they're under the PDT, instead of trading stocks, which is a lot easier and has a little bit less movement to it, they start trading options. But they're not trading options like a professional would trade options. Like in our room, Levi is so tactical. He trades only indexes, large cap names, and he's got such tight risk parameters on his options trades, and everything is tactical with his own algos and his own indicators that it's really precise. But most people are not gonna do that. They got a small amount of capital, they're going 0 DTEs right off the bat. Now I got 10,000 bucks, boom, I'm buying some SPY, some QQQ, 0 DTEs. Guys, those are so fun, they really are. But you can lose a lot of money very, very quickly because when you're doing 0 DTEs or even just some near-term expiration options, if you're just like sitting in them for an hour or so and they're not doing anything, you're already gonna be down 10, 20% just from the decay. And so you have to be really careful. You have to have a really acute understanding of those. Oftentimes when we trade options on indexes, It's not to over leverage, it's actually to use smaller amounts of capital, but be able to get right bigger percentage moves. So like you're taking just a small amount because they're already moving around so much. But what often happens is when you see something moving around in excess, you want to put all your money in it because you're thinking, wow, I could make 100%, 200%. But the downside of that is you probably go to zero. And that's why you see very rarely any big time options traders. Like you never see old and big time options traders. They don't exist because at some point the leverage gets too excessive and you put yourself in a bad position. But when you're new, it's just a complete no-no. You got 10 grand, take your 3-day trades a week, maybe do some swing trading, build it up to 25, 30,000 and do it the right way, $100, $200 at a time. That's gonna set you up for the long run. It ain't sexy, but it's gonna keep you in the game. Now the third thing that blows up traders, and I see this just all the time, is turning day trades into swing trades or investments. In the years that I've been doing this trading boot camp since 2008, I've taught literally thousands of traders. Over 5,000 traders have come through my program. And one of the things that I've noticed, it doesn't matter if you're sharp or not sharp, disciplined, not disciplined, people will fall into this trap sometimes. You know, you buy a stock, it doesn't do what you want, and all of a sudden, that day trade becomes a swing trade. And then that swing trade becomes an investment because it never gets back to where you are. It usually happens a lot with small caps. You know, they're flying around, they're $2, $4, $5. It sucks you into it. You top tick the buy, and then boom, right? The bottom drops off, and you're sitting there like, wow, I just lost 30% the next day, 40%. And so all of a sudden, your day trade turns into an overnighter that turns into an investment that usually just turns into nothing, right? You could be sitting on that for years before it ever comes back, but your capital is tied up. And so you don't want to do that. Your day trades are day trades, your swing trades are swing trades, and your investments are investments. Usually it's best to do these all in separate accounts so that you can keep things clear and your plans clear when you're making these trades, right? Don't shit where you eat. And that's just a big part of trading. For me personally, I do not do any swing trades in my day trade account. My day trades are for day trading, my swing trading is for swing trading, my investments are for investments. They don't cross swords at any point because once you start doing that, you don't really have any rhyme or reason. You're just buying stuff and selling stuff and going commando. But don't turn any day trades into swing trades because they're probably gonna turn into investments. So guys, let me know if you have any thoughts, questions, concerns. Make sure you smash that like button. Take care.